There's been some buzz online about a new topic, and it is possible that current and potential investors should give some thought of it. Last year, renowned billionaire Ray Dalio wrote an article titled The Popping of the Bubble Stocks, an update, in which he predicted that the stock market was about to experience a bubble similar to the dot-com crash and the Great Depression of 1929. Moreover, he mentioned that these bubbles may be broken down into six distinct measures that repeat throughout history, one of which is incredibly similar to what we're going through right now. This occurs when the stock market is having its worst year-to-date performance since 1939. Perhaps you are wondering what this bubble popping implies for us now. Alternatively, how will we be impacted by this declining possibility in the market, and many more. But don't worry, here at Investing Path, we will be providing you with all the answers to your questions and more. We will begin by analyzing past bubble cycles and drawing parallels to the current market trend. But before that, make sure to hit the like, subscribe, and bell button to stay updated for more of our content. Now, let's not waste a minute further and let's get started. Let's take a step back and get familiar with Ray Dalio before we continue, because his thoughts on the economy and the stock market are worth considering. The world's largest hedge fund, Bridgewater Associates, was created by Ray Dalio in 1975, and he currently serves as both co-chairman and co-chief investment officer. In that time, Bridgewater has amassed over $140 billion in assets under management while consistently beating the S&P 500, and Ray Dalio has gained over 45 years of macro investment knowledge during some of the market's biggest boom and bust cycles. Now, according to Ray Dalio, we are in the thick of a bubble right now. Market bubbles are a specific form of economic cycle characterized by rapid appreciations in market value, especially in asset values. In order to determine whether or not we are actually living in a bubble, he provided us with a set of 6 indicators to keep an eye on. First, the price is somewhat high when compared to the industry norms of value. Second, unrealistic expectations, such as relying on historical data to predict future financial performance. Third, naive purchasers are getting interested in the market for no other reason than that it is trending. Our fourth one is the optimism and general bullish sentiment. As for fifth, debt financing accounts for a sizable chunk of the market. And lastly, many forward and speculative purchases were made with the expectation that the price increases would persist. In fact, many of the largest corporate investments in recent years have rested on results that simply cannot be repeated. Several first-time buyers stepped in during the COVID-19 closure, and since stock prices can only rise, it is easy to see why investors would be enthusiastic. Many pieces of data have recently surfaced that, taken together, suggest Ray Dalio's theory that the market is currently in a bubble and will certainly collapse by the time you make an investment may be correct. He warned in January 2022 that the market was overvaluing certain companies, and his predictions were spot on. He pointed out that the bubble indicator was close to 70% of 1929 and 2001 highs, which indicated that some corporations were dangerously overvalued and close to collapsing under the right conditions. In any case, they were about to fall. Though fewer people shopped there, investor optimism was at an all-time high, and initial public offerings were up from 2001 levels. He was right to call them out though, because the stock market has popped since the initial report. The fact that they are not at a bubble extreme, however, does not mean that it is safe to go long or that now is a good moment to do so, as he emphasizes. In fact, based on our metrics, American stocks as a whole still appear to be overvalued. But he stresses that bubbles take a long time to collapse, so investors shouldn't assume that things are fine now that they aren't at a bubble extreme. Our data still indicates that US stocks are overpriced. He's right that after a bubble pops, prices will continue to decline. However, historical bubbles have often bottomed at around 20%, providing us some wiggle room. The question now is, how do we compare to the rest of the market with prices down ranging from 15 to 70%? New technologies have followed the same path as 2001 and 1929. In any case, he has demonstrated that the market is higher than normal, but declining relative to other bubbles. A similar high P over E ratio has been observed, but with fewer new investors entering the market. Prices have started to fall, even while current forward growth suggests there may be farther to fall. The biggest shock is the current record low in positive optimism. And here's why that final bit is so intriguing. After all, a recession often starts after peak optimism, not dread, and studies have shown that the more people fear a market crash, the less likely a crash actually is. Hence, hey, you know what? This might be a very decent time to buy. It's typically the response when consumer sentiment drops and bullish sentiment reaches an all-time low. Look at the numbers from the last 60 years and judge for yourself. When consumer confidence plunges significantly, the S&P 500 typically rises 23% during the next year. Have in mind as well the US Crash Confidence Index, which gauges market attitude and the likelihood that a crash may occur. Now, this is really important because the vast majority of evidence indicates that the average investor is almost always wrong on the most essential points. And if the average investor believes prices are about to go considerably higher, that usually suggests things are about to get a lot worse. The more nervous investors are, the more likely it is that we've hit the bottom, and the recent downward trend could be a precursor to a turnaround. Despite the fact that it seems like we are nearing a reversal, let us talk about the popular saying, sell in May and go away, to better grasp what this means for us as investors and whether or not Ray Dalio is right in thinking that we are still in a bubble. The phrase supposedly originates from the Old English proverb, sell in May, which was used by London's merchants and bankers after they noticed a drop in investment returns during the summer. It is widely believed, however, that the stock market performs poorly during the 6 months in the modern era. You may be wondering if there is any proof that events like this actually take place. The answer is that there is. It is true that the period between Memorial Day and Labor Day is a time when investors are less active in the market due to taking time off for vacation. Since 1928, the average return in May has been negative 0.1%, but from May to October, the average return has been 0.3%, and in 2021, May's return is expected to be 0.56%, up from 4.53% the year before. Additionally intriguing is the fact that stocks have delivered positive returns over every 6-month period between May and October over the last 10 years, despite May's poor track record. This is because the period from June to August has historically been the second best of the year, with gains 63% of the time and average return of 2.97%. Hence, while May often fares poorly compared to the other months, it has historically performed well. Also, let's be honest, it is plainly a bad idea to try to anticipate the market based on an old English phrase. Yet, Ray Dalio's findings show that the market is seen as expensive according to historical indicators. This is a good sign that people are starting to be negative, as irrational exuberance is a much stronger predictor of a bubble than excessive pessimism. Naturally, he also indicates that the market has more room to fall, with the condition that what one does with it is a personal choice. He then goes on to say that bubbles tend to overcorrect and sell off more than their fundamentals would predict. So if things get bad, prices will become worse, and that could be a good opportunity to keep buying in. Yet the real estate market is an entirely different story. In line with the widespread pessimism about the economy and stock market, a recent poll found that a record low 30% of Americans believe now is a good time to buy a home, marking the first time this percentage has been below 50% since the question was first conducted in 1978. If more people are scared away from the market because of the bad assessment, sales will decrease, supply will rise, and home prices will fall. Another problem is that housing affordability is at an all-time low since interest rates have climbed by 50 basis points, the biggest increase since 2000, with the average monthly payment having climbed by 72%. Since the beginning of the pandemic, we may soon reach a new low for housing affordability if prices continue to rise. Many people today are rushing into the market in an effort to beat the rising mortgage rates, with the mistaken belief that these rates would only rise further if they wait. One other trend is the lock-in effect, where homeowners are staying put rather than selling their homes and taking advantage of the market's current low interest rate. It is possible that now is a terrible moment to buy, if we use the same logic that says the typical investor is wrong 90% of the time. But kidding aside, now could be a wonderful time to re-enter the real estate market, as many sellers are eager to close agreements and get their money out of the property. What's more, rents are often stable over time despite the fact that prices fluctuate. If you want to be a long-term investor, then a steady stream of income is what you need. Yet, it shouldn't come as much of a surprise if rising interest rates lead to a slowdown in the markets, and some areas of the country may see significantly greater inventory in the coming years. Nonetheless, it is not surprising if prices remained high due to a lack of new development and high demand, at least until the restrictions were changed to allow for more construction and establishment. Now, it looks that Ray Dalio was correct in identifying some market segments that were considerably overvalued and have subsequently fallen significantly, solving the mystery of why the market is likely to tumble. Plenty of money could have been lost if you didn't cash out of the SPAC IPOs or growing tech during stay-at-home plays. Yet, it is considerably more difficult to ascertain whether or not the market as a whole is overvalued, and the fact that data implies that it is substantially overvalued relative to historical data does not exclude it from going much higher. As for us, we think the best way to deal with this is to spread your investments around as much as possible, whether they be in stocks, real estate, cash, or even a tiny amount of cryptocurrency. Just give up trying to figure out why prices are shifting and just accept that it's out of your hands. On the other hand, what are your thoughts about Ray Dalio's view of the stock market so far? Do you think he is right, or do you have any another perspective in mind? Let us know what you think in the comment section below. But besides that, thanks for watching. This is Investing Path, and if you enjoyed watching this video, then go ahead and hit the like, subscribe, and bell button to see more of our future personal financing and investment uploads for you. Thanks again for watching, and we'll see you in your next video.